The housing market has been a wild ride through history, with dramatic booms and devastating busts that leave lasting impacts on economies and everyday lives. In this video, we're digging deep into the biggest housing bubbles and crashes, exploring what fuels these explosive price surges and, just as quickly, causes them to collapse. These cycles can feel unpredictable, but history reveals clues that can help us better understand today's housing trends and what they mean for us. So, what creates a housing market boom? It starts when demand for homes skyrockets, often due to low interest rates, easy access to loans, and the widespread belief that prices will keep climbing. Homes become highly valuable, and people start buying quickly, both as places to live and as investments. But when prices rise far beyond what people can actually afford, a correction is usually around the corner, and that's when a bust happens. Prices fall, people end up underwater on mortgages, and the market enters a crisis. This boom and bust pattern is a tale as old as the market itself, and by understanding it, we can see what might come next. Our journey begins in the United States during the Roaring Twenties, a time of lavish lifestyles, new technologies, and an economic surge. Real estate was a hot market, especially in places like Miami and New York, where people thought prices could only go up. Fueled by this optimism, people bought properties as investments, expecting big returns. Banks lent easily, and credit was flowing. But when the Great Depression hit in 1929, the market took a sharp nosedive, leaving people with properties worth far less than they had paid. It was a devastating crash that demonstrated the dangers of unchecked speculation. The housing bust of the 1920s serves as a powerful example of what can happen when people rely too much on a sure thing in the market, a lesson that is just as relevant today. Next, we jump to Japan in the 1980s, a period marked by rapid economic growth and massive property investments. Japan's economy was booming, with a powerful manufacturing sector and one of the strongest currencies globally. Tokyo's real estate prices rose to dizzying heights, making it one of the most expensive cities in the world. Banks were eager to lend, and many investors believed the market would keep going up. In fact, Tokyo's Imperial Palace alone was once valued at more than all the real estate in California, but this frenzy couldn't last forever. When the bubble finally burst in the early 1990s, Japan entered what became known as the Lost Decade, a period of economic stagnation that lasted much longer than a decade. Property prices plummeted, leaving the market struggling for years to recover, and Japan's economy slowed down dramatically. This was a wake-up call that no market is immune to correction, no matter how strong it seems. The lesson: over-leveraging and unchecked optimism can lead to a painful, long-lasting bust. Then there's the 2008 financial crisis, perhaps the most infamous housing market collapse of modern times, and one that affected not only the US but economies worldwide. This wasn't just a US bubble, it was a global disaster fueled by risky loans and a market that was far overvalued. Leading up to the crash, mortgage lenders gave out subprime loans, loans with high risk, to people with low credit scores, betting that rising property values would cover any defaults. These mortgages were bundled into complex financial products called mortgage-backed securities and sold to investors. The whole system was built on the idea that housing prices would never fall. But when the bubble burst, millions of people lost their homes, their savings, and their financial stability. Banks went bankrupt, and the ripple effects led to a global recession. The 2008 crisis brought about major changes in financial regulations, but it also showed just how connected housing markets are to the overall economy. This was a harsh reminder that risky lending and speculative buying can lead to widespread financial pain, and that housing bubbles can have devastating effects beyond real estate alone. So how does today's housing market stack up against these past crises? Are we heading for another crash, or have we learned from history? Today, there are some familiar signs. Prices are high, inventory is low, and there's a lot of investor activity. But today's market also has unique influences, especially from the COVID-19 pandemic. Lockdowns and remote work reshaped where people want to live, driving up prices in suburban and rural areas as people left crowded cities. With record low interest rates and government stimulus packages boosting people's ability to buy, demand surged. But now, with interest rates climbing again, many are asking if the market is due for a correction. Looking back at past bubbles, we can see similar warning signs when prices rise faster than incomes, and when people rely on credit to buy beyond their means, a bust often follows. By studying these historical cycles, we see that housing markets are often shaped by optimism and the belief that prices will keep rising even when there are clear signs of risk, when banks are too willing to lend, when people are taking on too much debt, and when everyone assumes the boom will last forever. That's usually when things start to unravel. Understanding this pattern gives us tools to make smart choices today, whether we're buyers, sellers, or investors. If we know what to look for, we can spot red flags before a bubble bursts. For buyers, that might mean waiting for more reasonable prices or choosing a home within their budget instead of stretching too far. For sellers, it could mean watching the market closely to sell at the right time. And for investors, understanding these cycles can help them avoid risky investments during a peak. Now, as we look forward, one thing is certain: history doesn't repeat exactly, but it often rhymes. The housing market affects so much more than just property values. It shapes entire communities, affects generational wealth, and can even impact political stability. As interest rates rise, government policies shift, and new trends emerge, the housing market will continue to evolve. Knowing what past bubbles and crashes look like gives us valuable insight into the forces at play today and in the future. Whether you're planning to buy a home, invest, or simply keep an eye on market trends, understanding these patterns can help you make choices that protect your financial security. So as you think about the future, remember the lessons of the past. Be cautious, avoid speculative buying, and always plan with a long-term view. History shows us that the housing market will always have ups and downs, but by staying informed, we can make decisions that help build a financially stable and resilient future.